Let's touch base with Vinit Bolinjkar, who's head research at Ventura Securities, joins us in our studios. Vinit, it's great to have you in the show. Thanks very much for taking out the time. How are you approaching the upcoming earnings season?
We are pretty positive. I think this will be one of the best quarters around, and with the markets having corrected significantly, I think this month should be good along with the result season that comes out.
What makes you feel that this would be best quarter when it comes to earnings?
Basically, all the actions that the government has taken and with the GST and all the demo effect all through, and with the monsoons being very good, we should see consumption come through. So I believe that this quarter should be very strong.
But that would take some time for get captured into earnings. This very quarter which we are expecting earnings, you think even that would be reflecting what government has done in recent past?
Yeah, so let's take cues from the auto numbers. They've been very significant. A lot of it coming from the rural story, and rural consumption also growing 8+% with very little deviation from the urban growth rate. So I think the government's policies have started playing out, and with this MSP also being decided, we are getting more bullish on the rural consumption theme. So this should drive consumption stocks, plus infra is in full swing, and targets are also being stiffened by the government. Timelines are being compressed, targets are getting stretched. So that augurs well for the market, which buoys on growth. So growth factors are coming to play, and we expect the stock markets to follow.
Okay, fair point. Vinit, let's talk individual stocks, and I sense that you see value in SAIL right now. Why is that? What is it that you find attractive about SAIL?
So, if I may digress a bit here.
Sure.
There are three players which are significant, the big boys, which is SAIL, TISCO and JSW. Right? Today, SAIL has become the largest steel producer. And if you see, Tata Steel is fully integrated. JSW buys iron ore and coal, while SAIL is the only player. He is integrated on iron ore but buys coal from outside, right? So these are the differentiation in these three stocks, and what logically follows is that the EBITDA per ton of these players should be in accordance. Now in SAIL, over the historically, 30% of the product mix was intermediate, so they were not getting the value for the money. So now that is going to see a transformation, and an EBITDA which was around 3,000 plus will now in the Q1 be around 8,000 bucks per ton. So it is catching up with JSW, which is around typically 9,000 plus EBITDA per ton, and Tata Steel, which is around 14,000 EBITDA per ton. So this is the operating efficiency that is kicking into SAIL. Plus they have got volume growth of, they added capacity at 21 million tons. So they make about 20.2 million tons of finished steel from currently 14 million tons. So that's a good addition of 43% expansion. The bulk of that expansion we will be seeing in FY19. Now if you go below the EBITDA, what happens is that the capital efficiency of SAIL is far more is the best among the three. So Tata Steel has debt of close to 100,000 crores, JSW is 70,000 odd, and SAIL is at about 45,000, which over the next 3 years will come down sharply to about 30,000. So there's a lot of capital efficiency where there was inefficiency in production because of pure wage count. They have 76,000 laborers compared to 10,000 of JSW and about 36,000 of Tata Steel. So all with the volume growth, EBITDA expansion, product mix and operating leverage and reducing debt, and the stock is available at 4 times FY21. And if you take, move from the micro to the macro, India's steel consumption is about 75% utilization, and for a growing economy, I think we'll be hitting 90-92% by FY21, and there is not too much capacity coming up. Nothing is on the line as such. So given these things, I think pricing will remain firm in our country. Right now, globally, we are at parity pricing with imports.
Right.
And finally, these trade wars are not going to impact us much, because I think our government is aware and is very sensitive to protecting the interests of our economy. So given these things, we are quite bullish on SAIL, and we think that the stock can give you a 50% upside from here.
Okay. Is SAIL your most high conviction idea from the metals pack, or do you like something else?
Yes, no, we like SAIL. I think it's a high conviction idea.
Okay. Vinit Bolinjkar is still with us. Vinit, we were talking about ITC and the prospects of the business here. ITC has still not taken off in terms of capturing the upside there is from the FMCG side of the business. You know, in the market, it's still seen as a cigarette maker, cigarette manufacturer, and that being the cash cow. You know, the market is yet to capture the transition and the upside that comes in from the earnings pickup of the FMCG business.
Yeah, so I think we are at that inflection point in the other non-cigarette businesses. So going back to understanding the cigarette business, I think the sin tax collections for the month of April and May have been very buoyant, and they're ahead of government estimates. So we do not expect much sin tax being added on this year. So that is number one. So volume growth also should be positive this year, though it will be early single digits, but that's a plus. And generally the company takes a price hike every year. So that will flow directly to the bottom line. So it will impact profits very positively. Another thing we have to understand, FY18 was a tough year for ITC. Despite that, they grew margins very aggressively. They almost added about 150 basis points. That was purely because of cost efficiencies. And now as we discuss the other segments, I think the hotels is in a very sweet spot. Okay, after 15 years, we are seeing for the first time demand for occupancies exceeding supply of rooms, and this is likely to persist, and slowly what will happen is that the occupancies will go up and so will the average room rentals. So that should entirely go to the bottom line. Already the hotel stocks have been squeezed on efficiencies, and the survivors will gain manifold from here. So I think the ITC is best placed on that. If you talk of the FMCG business, I think the EBIT margins have started improving. So they were at 0.5%, they are now at 3%, and over the next 3 years, the EBIT can double from here. And if you look at paper segment, also mimics the economy, and with all this plastic ban coming in, we could have some little more traction out here. And the agri-export business, which was facing a little trough because of a strong rupee and poor and a drought in Andhra, with the rains coming around and the rupee having depreciated. So this segment should also start looking good. So I think given all these things and the fact that it is one of the cheapest stocks in the FMCG segment, which the market is not taking cognizance of, I think there is the value gain and the risk reward ratio is extremely tilted in the favor of the investor.
There's also bike hospitality, which you've liked, you know, while there aren't much volumes in the stock, but nonetheless, after hitting a year high of 215, currently the stock is around 148 thereabouts. What is it that you like about it? Have you been a buyer in this current decline in bike hospitality, and have you added fresh positions there?
So, you know, if you see the entire hospital space, a lot of the players are saddled with debt. There is bike hospitality is a very small cap player which has got very little debt on its books, and they have a very asset light business. So they do not own properties, they lease out properties for a long term and 10 to 15 years, and they are now building their brand. So they have about so if you go to Mathiran, you know, it is one of the preferred destinations to travel to. So what happens is that the plus point of this chain is that they offer you only vegetarian cuisine. So that is very favorable for a domestic, not meat eating travelers, you know, where you get pure vegetarian food. Also, they have grown very well. They have got very high ROCEs. And earlier they were also into the segment of buying rooms on bulk and then selling them out at margins. So they are going slow on that business and building up their brand as such. So from 750 rooms, they are looking to double over the next 3 years, And as we spoke about the hotel segment being extremely lucratively poised, I think this play, which is very, very niche, should do extremely well going over the next 3 to 4 years.
Right. Thanks, Vinit, for sharing that idea and joining us with your other aspects of market. Right, you're bullish on market, you're liking SAIL, you're liking ITC, and some of the mid-cap names in hospitality sector.